love municipal bonds. Municipal bonds are really fun. Fun, 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 fun. Municipal bonds confidential.
Another traditional risk of buying and holding municipal bonds is probably not one you have heard of. Nor is it one you would think about unless you understood bond math. Unfortunately, it is a risk that could impact the price of your municipal bonds just as much as credit risk, even though credit worthiness and financials have nothing to do with it. It is called interest rate risk. And it usually comes as a surprise if not a shock to individual investors when they see the statement evaluations of their municipal bonds decline, or get an actual secondary muni market bid below what they paid. Simply put, interest rate risk has to do with the inverse relationship of bond prices to interest rates. Interest rates and bond prices move in opposite directions. If interest rates go up, the price of your municipal bonds go down. It should be said that when interest rates go down, and interest rates can decline for many reasons, the price of your municipal bonds go up. Investors would have no cause for alarm if the value and price of their municipal bond holdings rise in price. Sounds great. And if interest rates stay down, for whatever reason, then those higher bond prices stay high, and those high bond prices may even seem to be stable. Also sounds great. But, if the economy and markets, including the Muni Markets, turn direction and head toward rising interest rates, then the prices of your municipal bonds will decline. If interest rates have already gone up, then when you next check the bid side evaluations on your account statement, or actual bids for your municipal bonds, the prices of your municipal bonds will be lower. There are no ifs or maybes to this. If interest rates rise, the price of your municipal bonds will, I repeat, will go down. Be forewarned. And again, this has nothing to do with the credit worthiness or financial soundness of the state or city or whatever municipality whose municipal bonds you purchased. Everything could be the same or good or even great with the issuer of your municipal bond. Yet the price of your municipal bond is dropping. And you think, what the Muni market? Why are my municipal bond evaluations and prices going down? The answer has to do with interest rates and bond math. Allow me to explain by case study. You as an investor buy a 30-year maturity municipal bond with a fixed coupon yield of 2% at a price of par, or 100, you would have a fixed current yield of 2% as well as a fixed yield to maturity of 2%. You make this municipal bond purchase when going Muni market conditions have 30-year municipal bond yield to maturities, priced at 2%. Then, economic conditions change. Market conditions change. Interest rates rise. Market conditions now have 30-year municipal bond yield to maturities at 4%. Interest rates have risen from 2% to 4%. An interest rate rise like this would be significant. It would be a bad thing for the market price of your municipal bond. Ask yourself, would you rather be paid 2% interest or 4% interest? Of course you would want the higher interest rate. You would want 4%. However, you own a 30-year municipal bond with a fixed coupon rate that pays 2%. You would not be able to sell this 2% bond because any other investor would obviously purchase the 4% bond. To compensate, the price of your existing 2% municipal bond goes down in order to raise its yield to maturity to 4%. The price of a 2% coupon municipal bond would need to fall far enough to make the overall investment comparable to the 4% yield to maturity now available on newer or other 30-year municipal bond investment options. This is the inverse relationship thing. Interest rates go up, bond prices go down. It also has to do with a thing called yield to maturity. There is more bond math involved here. Yield to maturity is different from coupon rate, and different in many ways than current yield. Ask your financial advisors and brokers about interest rate risk, and the inverse relationship between interest rates and bond prices, and ask them to explain yield to maturity. Please note, Wall Street does attempt to find opportunity in down markets as well as in up markets. They are bookies after all. Correction. Wall Street are brokers after all, not bookies, brokers. Oops. When interest rates rise, and bond prices fall, you will hear investment strategies intended to make you feel better, and that actually could make mathematical sense. One such strategy you will hear and maybe be advised to undertake is a double trade tax loss swap. This would be double good for your Wall Street broker. Maybe good for you. Regardless, it would still be putting lipstick on a pig. The reality is your municipal bond price and value has gone down. The confidential truth is that municipal bonds, like all bonds, which are referred to as fixed incomes, because everything is fixed, do have a variable part. That variable part is their market price. And the market prices of municipal bonds can go down because of many types of credit risks, as well as a thing called interest rate risk.
I love municipal bonds. Municipal bonds are really fun. Fun, 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 fun. Municipal bonds, Confidential.